Welcome to Manifested e-learning platform. Today we are talking about taxation of extractive industry. And so we say taxation of petroleum, taxation, on that we say taxation. We say taxation of petroleum, taxation of petroleum and petroleum companies, taxation of petroleum companies, taxation. Remember, petroleum industries are basically extractive, and companies service subcontractors, and companies service subcontractors. Remember, petroleum industry is an extractive industry. So taxation of the petroleum companies and companies service subcontractors. So we start with the terms used. We start with what we call terms used. Terms basically used under the petroleum, in petroleum operations. Terms used in petroleum operations. Terms that are basically used in petroleum operation. So the terms that we basically use under petroleum operation. So we have the first term, that is what we call petroleum agreements. Petroleum agreements. The first term is what we call petroleum. What we call petroleum agreements. The first term is what we call petroleum agreements. And when you talk about petroleum agreements, these are basically contracts, agreement between government and petroleum company, agreements between petroleum company, agreements, contracts of agreements. These are contracts. Contract is the same as agreement. Those are basically agreements. Contracts of agreements between, we say between government and petroleum companies, agreements between government and petroleum companies to carry out, we say that to carry out petroleum activities, There should be this contract. When you talk about exploration, especially the ones that are done in a particular country, there has to be agreements between these petroleum companies and the government to carry out exploration or the petroleum activities. So the next time we talk about contractor, the next term is what we call a contractor. We call a contractor. Who is a contractor when you talk about a contractor? This is usually a petroleum company which has concluded petroleum agreement. A contractor is basically a petroleum company, is a petroleum company, basically a petroleum company which basically has concluded an agreement with the government, which has concluded, an agreement, which definitely has concluded an agreement with the government. A petroleum company which has concluded an agreement with the government. So we say contractor, in this case, is the petroleum company that basically was having an engagement with the government but has concluded, meaning that it can start the operation. So that is a contractor. The next term under exploration, we have what we call petroleum operations. Petroleum, what we call petroleum operations. Operations are basically activities that are basically carried by a petroleum company. And what are these activities? We have exploration, extraction, storage, and selling of petroleum product. So we say these are activities. These are activities relating, we say activities relating to exploration, extraction, comma, storage, and selling of petroleum product, and selling of petroleum product, and selling of what we call the petroleum products, and selling of the petroleum product, and basically selling of the petroleum product. That is what we call the petroleum operation. Activities that a petroleum company engages in, and we have talked about exploration, extraction, storage, and selling of petroleum product, because that is the major source of revenue for these petroleum companies. Then you go to what we call petroleum products. Petroleum products. We have what we call petroleum product. Petroleum products. You know, these are products that basically emanate from this petroleum activity. We have mineral oil, crude oil, natural gas, carbon. Those are the products. See, these are means mineral. This means mineral oil. We have the crude oil. We have the crude oil. We have the crude oil. Natural gas. Natural gas, comma, carbon. Natural gas, carbon produced from tar, carbon produced from tar. So these are the product, petroleum product, what basically originate from these petroleum extraction activities. So then we go to petroleum company, sub-service contractors. Petroleum company, sub-service contractors. Petroleum company, sub-service contractor, very important term. Remember, the reason why we talk about these terms is very, as we get to particular questions, or as we delve into this topic, these are terms that we will be able to come across. When you talk about the products, selling of those are, we need to get to understand them, because some of the sources of revenue when you talk about petroleum product is what we sell. If we sell them, that is a source of revenue. We talk about petroleum company, service subcontractors. We say service, we call it service subcontractors. So when you talk about the service subcontractors, when you talk about service subcontractors, we basically means the purpose, for tax purpose, service subcontractors you sublet. So we're basically saying that for tax purpose, they're considered as a non-resident. For tax purpose, we need to understand for tax purpose, this for tax purpose, in relation to taxation, they are considered a non-resident. They're basically considered a non-resident. And the implication of considering the subcontractors as a non-resident, it basically implies that we need to tax them at the rate of 37.5%. We need to tax them at a rate of 37.5%. At the rate of 37.5%. But you also need to understand that company contracted by, they are contracted by. So service subcontractors, they are contracted, or they are called upon by these petroleum companies to carry out specialized activities. Contracted by petroleum companies, petroleum companies, we say that they're contracted by petroleum company to carry out, we say that to carry out specialized operation, to carry out what you call specialized operation. These are some of the operations that, you know, the petroleum companies are not able to carry out. But very important, I have said on these service subcontractors that in relation to taxation, mark the word, they're considered non-resident. And you say, when you say non-resident, then we need to tax them at a corporate rate of 37%. 37%. We need to tax them at the rate of 37%. So then we go to what we call production. Production. The next term is what we call production. We call it production. So when you talk about production, it's basically coming out, you know, to give rise to something. So we basically say that quantity of petroleum produced, quantity of petroleum, we say quantity of the petroleum produced, quantity of the petroleum produced and saved, and you say excluding what you call excluding petroleum used in operation, excluding petroleum used in the operation of petroleum companies. Excluding the one that is used in the operations of the petroleum company. Then we go to what we call production expenditure. Production expenditure. So when we talk about production, you know, those are quantity of petroleum that are produced. So expenditure, those are basically costs that we incur in the production of those products. So we say that our capital, these are day-to-day expenses. These are day-to-day. These are day-to-day expenses of a petroleum company. Why do you say is a day-to-day expenses? Because the major activities of this is extraction. And so basically what happens is that this when you talk about production expenditure, this will be emanate to a day-to-day expenses, but they relate to extraction. Then you can talk about what you call qualifying expenditure. What you call qualifying expenditure. Qualifying expenditure. We have what you call qualifying expenditure. Very important to understand that qualifying expenditure, these are basically capital expenditure. We can talk about capital expenditure in kind operation, capital expenditure, we say incurred in the operation of a petroleum company. Capital expenditure incurred in the operation of a petroleum company, incurred by a petroleum company. Capital expenditure that in a petroleum company, other than intangible, other than the intangible drilling cost. other than intangible drilling cost. But the word capital expenditure means basically expenditure that we incur, expenditure on fixed asset, expenditure on fixed asset. So some are, they include the following. They include, one, we know that plant, we have what we call plant, machinery, comma, what you have as furniture and fittings. We have furnitures and fittings. Number two, we can talk about what we call pipelines, storage tanks, pipelines, what you have as pipelines, comma, storage tanks, the second, and we can have our third one, qualifying expenditure, the capital expenditure. We have what we call industrial buildings in Kenya. Industrial buildings in Kenya. What we call industrial buildings in Kenya. We'll move to the next term. And we need to understand that for the capital expenditure, we claim investment allowance. We know that under extraction or mining investment allowance, we know that that is 50% in the first year, 25% on a straight line from the second year on the remaining balance. So the next term, we call it a well. So a well is opening of ground through which oil is extracted. Opening from the ground, through which oil is extracted. An opening from the ground through which oil is extracted. That is what we call a well. Then we can move to the 10th one. So we proceed on the last term, that is what we call intangible drilling. We call it the intangible drilling cost. So when you talk about the intangible drilling cost, we know it refers to expenditure, refers basically to the expenditure, which have no salvage value. So, and when you talk about salvage value we know is what we call a residual value, the value that we have at the end of the operation, which have no salvage value, which are incidental to drilling. We say that which are basically incidental to drilling, cleaning, comma. We have deepening, completing, and what we call abandoning of the well, and what we call abandoning of the well, and what we call abandoning of the well. So we say that they include intangible drilling cost. We know that they include what we call cost of determining well location, cost of determining the well location, where to dig the whole location, well location, cost of determining what we call the well location, cost of determining the location of the well, We can also talk about geological, cost, geological costs. We have what you call geological cost. We had the geological. These are now the intangible drilling cost. So then I want us to proceed to determination. Determination. We start on the determination of the taxable income for this extraction. Determination of the taxable income. How do we determine the taxable income? Determination of the taxable income. How do we basically determine the taxable income for this extraction? So we know that taxable income is determined using, we say that the taxable income is basically determined using basically two methods. That is what we call the net profit method. The net profit method we apply when we have been given the accounting profit. And therefore, using the net profit method, we need to adjust the accounting profit to get the taxable income for the extractive company. Then we have the second method, which we call the gross profit method. For the gross profit method, we are not given the accounting profit. And so we get the taxable income, then we less what we call the allowable expense. So we're saying that the two methods are basically net profit method, and two, we have what we call the gross profit method. Again, we know that for the gross profit method, accounting profit is not not provided. For the net profit method, we have to be given the accounting profit. After determining this, the taxable income, we say that petroleum companies are taxed at a corporate rate of 30%. So after determining the methods, after we determine the taxable profit, we need to understand that they are taxed at corporate rate of 30% for resident, and 37.5% for the non-resident, companies, and 37.5% for the non-resident company. So for the non-resident company, I've said that for the resident company, we tax them at 30%. For the non-resident, we tax at the rate of 37.5%. The following, basically, as we were saying, that for petroleum companies, which are extractive company, we tax resident company at a corporate rate of 30%, and 37.5% for the non-resident company. And then we need to understand that the following specifically applies. The following specifically apply to petroleum companies, petroleum companies. So the following specifically apply to petroleum company. Under this specialized, one of the most important things is the basic, our concept on taxable income and non-taxable income. That is basically a concept that was basically touched on the intermediate. We need to understand the taxable incomes, like for example, The taxable income for general business, we know that for realized foreign exchange gain, trade debts that were written off, that were previously written off and recovered, that's taxable income. We also need to understand that reduction in specific bad debt is also a taxable income. We also need to understand that compensation from insurance company for the loss of stocks is also a taxable income. So when you get to this specialized, and now the following specifically apply to petroleum company, we have what we call additional taxable income. We have what we call additional, we call it additional taxable income. We call it the additional taxable income. Apart from those that I've mentioned, now these don't specifically apply to petroleum company. One is what you call amount received from the sale. Now, what are we engaged in? If you're a petroleum company, we are basically engaged in selling products that emanate from extraction of petroleum. So, sale of petroleum products, one of it, sell, additional taxable income, sale of the petroleum, we say sale of the petroleum products, sale of the petroleum products, what we call the sale of the petroleum products at arm's length. We say at arm's length. The second we have as a source, because those are specifically for the petroleum, income of what we call disposal, interest, income of disposal interest in petroleum activity, in what we call petroleum activities, income of disposal interest in petroleum activities at arm's length, at what we call at arm's length, at arm's length. Then we have sales at arm's length. Sales is at sales is basically sales is at arm's length on meeting. We say on meeting the following. We say on meeting the following conditions. The sales basically is at arm's length on meeting the following conditions. For sales basically to be at arm's length, one of the conditions is that money is the only consideration in the sales agreement. At arm's length is that money is only the consideration in the sales agreement. That for sales to be at arm's length, money is the only condition. Money is the only condition. Money, we say money is the only consideration. Money is what you call the only consideration. Money is only the consideration. Money is only the consideration. We say that money is only the consideration in the sales agreement. In the sales agreement. In the sales agreement. But very important, you need to understand now for these major items that you're going to add have as taxable income relate to the sale of petroleum products and incomes of disposal interest in petroleum activities at arm's length. And I was saying that the first, when you talk about arm's length, for sales to be at arm's length, one of the conditions that money is the only consideration in the sales agreement. The second, we can talk about terms of sales. We say that the terms of sales, the terms of sales, what you call the terms of sales, the terms of sales are not determined, are basically not determined, are not determined by any other factor, are not determined by any other factor, are not determined by any other factor other than commercial, any other factors other than other than what you call the commercial, other than the commercial relationship, other than the commercial relationship between, other than the commercial relationship between the seller and the buyer. The seller is the petroleum, other than between the seller and the buyer, other than the commercial relationship that exists between the seller and the buyer. And the seller in this case is the petroleum company, that is at arm's length. Then lastly, we just say seller does not have, seller does not have any interest, does not have any interest. The seller basically does not have any interest in the subsequent, we call it in the subsequent, what do you call the subsequent resell? You know, what happens after that, whether you want to sell it again in the subsequent resell of the petroleum product, of the petroleum, resell of what? Of the petroleum product. It does not have an interest of the petroleum product, on the petroleum product, on the petroleum product. So that is on taxable income. The first point was basically on taxable income. We have mentioned two very crucial things, that when you're engaging in petroleum product, realize that what are you doing? What you're going to do as a contractor is to sell the petroleum product. We have income of disposal interest in petroleum activities at arm's length. And we've talked about what we basically mean sales at arm's length. One key thing that we notice is that money is the only consideration in sales agreement. The terms of are not determined by other factors other than the relationship between the seller and the buyer. Seller does not have any interest in what we call subsequent resell. You know, whether you buy and you decide to resell those products, it does not have what we call interest on that. So I want us to move again to the next item, additional allowable expense. This should be additional allowable expense. Additional allowable expenses. What we call additional allowable expenses. So when you talk about allowable expenses, basically in taxation, these are expenses that we know can be deducted against a taxable income. These are expenses that can be deducted against a taxable income. Very precisely, we talk about on the general taxation of a limited company, we talk about some of these expenses as increase in specific provision for bad debt. We also talk about unrealized foreign exchange loss as additional allowable expense. We also have some of the legal costs when you talk about renewal of a lease that is less than 99 as allowable. But now when you talk about specialized, for example, you know, when you talk about now mining, the specific that needs to be added to such, the specific that needs to be added as additional, the ones that are specifically needed to be added apart from the ones that are generally applies to the companies, like I've mentioned, increase in specific provision for bad debt. I have also talked about realized foreign exchange loss. So for the petroleum, some of them we say they include. We say they include. We can have one, what we call intangible, all intangible drilling cost, all intangible, what we call all intangible drilling costs. So when you see this as part of expense, geological and geospatial, geological, e.g., we call it geological costs. So when you see such an expense on items, for example, on items, when you're given an information to get the taxable income of an extractive or petroleum industry, if you see intangible drilling costs, those are basically allowable expense. Amount paid Amount, we say amount paid to the government, in relation to the agreement, amount paid to the government in relation to the petroleum agreement, in relation to the petroleum agreements. Amount paid to the government in relation to the petroleum agreements. One thing that you need to understand, particularly on those amounts, we need to understand that one of the things that is not included, we need to understand that tax excluded. Under this, tax should be excluded. Tax is not part of that. If tax was paid, tax basically should be excluded, or tax not included. Excluded means tax not included. So then we have what we call another additional administration cost. We have what we call administration costs. Administration cost, to manage administration cost, management fee, and what we call professional fees paid in Kenya, and the professional fees that are basically paid in Kenya. Those are additional allowable expense. Allowable, we say that you can deduct them against taxable income. And this, note this carefully. Point 2, amount paid to government in relation to petroleum agreement, tax excluded. So the tax that is paid is not allowed. Amount paid to petroleum company, amount paid to petroleum company, service contractors. Sub-service contractors are basically involved for specialized work. Then we can also talk about production expenditures, what we call production expenditure. And you say that production expenditure, day-to-day running costs that are basically for running. Then we talk about interest on loan. We have interest on loan, borrowed, and we say invested into the petroleum company. Interest on loan borrowed and invested into the petroleum company, petroleum company's activities in Kenya. Activities in Kenya. So we can put another one. These are basically capital expenditure. We talk about capital expenditure. Petroleum investment allowance, what they call petroleum investment allowance. Those are fixed assets that relate capital expenditure. Granted, we need to understand, granted on what we call capital expenditure. Granted specifically on capital expenditure, such as we have the plant, we have specialized mining, specialized mining, mining machines, specialized mining and drilling machines, and drilling, specialized mining and drilling machines, specialized mining and drilling machines. We have pipelines, and then we can talk about tanks and industrial buildings, tanks, and what we call industrial buildings. Tanks and industrial buildings. So this is just based on investment allowance. And we need to understand those investment allowance. We know that there is investment allowance at the rate of 50% in the first year, 25% per annum on a straight line. From the second year on the remaining balance. Those basically involve manufacturing, items in mining, like the extractions that we have. We also have farming, but we say that those will be granted petroleum investment allowance. That we need to understand the investment allowance. We need to understand the investment allowance. To be very specific, that we know that these ones should be basically at 50%. Under mining, if you look at the tax table, that should be basically 50% in the first year, and we say 25% per annum on a straight line from the second year on the remaining balance. So investment allowance under petroleum industry, we talked about, we grant it on capital expenditure. Under petroleum, that is mining and drilling machines, pipeline, tanks, and industrial buildings. So we need to understand that we grant it under mining, investment allowance is granted. We say granted at the rate of what we call 50% in the first year. 50% in the first year, 25% per annum on a straight line, 25% per annum on a straight line, from the second year, from the second year on the remaining balance, on the remaining, what we call the remaining balance, on the remaining balance, from the second year on the remaining balance. Implying that after getting the 50%, now the 50%, we get it 25, implying that 4 years. For this investment allowance, they should take about 5 years. The first year, 50%, then the others should be taking 25% of each of those 50% that is remaining. That should be about 4 years. Then we have another normal, we call it 7, normal investment allowance. Remember, this investment allowance is basically applying to mining machine in normal investment allowance for fixed asset, normal investment allowance for the fixed assets, for other investment, for other investment. For example, when you have items like motor vehicle, we all know that they should be under investment allowance at the rate of 25% on a straight line. We know that if you have items like furniture and fittings, they should be under investment allowance at the rate of 10%. So those are other investment allowance at 25% and 10%. Those can be granted, such as other investment we say normal investment allowance for fixed asset. For example, we say, motor vehicle, which I said furniture. We have the furniture and fittings, furniture and fittings, etc. So other investment, furniture and fittings, those should fall there. Then we have cost of well abandoned, cost on well abandoned. So cost, remember this cost on well abandoned, abandoned, on failure to discover, we call it to discover oil. So cost on a well that is abandoned, when you fail to discover oil, that should also be allowable expense, and that needs to be noted. That oil, when you talk about a well, these are holes that from underground that we use for extraction of oil. So we're basically saying that for those wells that are abandoned as a result of failure, to discover oil, those will also be allowable expense. We have what we call commissioning and mobilization cost. Commissioning, what do you have as commissioning? Commissioning, what you call commissioning, and what you call the mobilization cost. Commissioning and what you call the mobilization cost. Commissioning and what you call the mobilization cost. So what are commissioning and mobilization cost altogether? Because sometimes you ask what is commissioning and mobilization cost. We know that our cost incurred are the cost incurred to take, are when you talk about commissioning, are the costs that are incurred to take away resources from the mining, we call it, from the mining, to take away resources from the mining site, we say in case of what we call failure, in case of failure to discover oil, discover oil, in case of failure to discover oil. Then we can have a last one, in case of failure to discover oil. We can talk about lifting and extraction cost. What we call lifting and what we call extraction. We call it the liftings and extraction cost. Lifting cost, these are basically involved under mining, what we call the lifting cost, lifting and extraction cost. We know cost to bring oil to the surface. Cost to bring, when you talk about extraction and lifting, cost to bring oil to the surface. We say to bring oil to the surface, from underground to the surface. Cost to bring the oil to the surface. And then we talk about, we can also talk about memorandum of understanding, credit granted by government. Memorandum of understanding, credit granted by the government. So we can move to what we call taxation of petroleum service subcontractors. Taxation, we move now to taxation of what we call the petroleum service subcontractors. That is the PSS. PSS, subcontractors. Remember, we say that when you talk about the subcontractors, when we say the subcontractors, these are basically hired. They're hired to carry out specialized activities under extraction. And we did say under the terminologies that we basically treat them as non-resident. We basically treat them as non-resident. We basically treat them as non-resident. And by the virtue of treating them as non-resident, we basically know that we need to tax the non-resident at a corporate rate of 37.5%. So we need to say considered to be non-resident. The first thing we need to know, considered. We say considered to be what we call non-resident. Considered basically to be non-resident. Considered to be non-resident. And by the virtue of considering them to be non-resident, we need to understand that we tax them at 37.5%. So considered to be non-resident company, and therefore, we need to understand, and therefore, we say taxed at a corporate rate of what we call 37.5%. And therefore, we tax at corporate rate of 37.5%. Taxable income, we need to understand that the taxable income of, we need to understand that the taxable income of petroleum service, petroleum, the taxable income of a petroleum sub-service company, very important company, is of a service company is usually taken as what we call 15% off, is usually basically taken as 15% of the amount of the amount received from the petroleum. For this service company, service subcontractors, we say that the taxable income is taken, taxable income of petroleum service company, 15% of the amount received from the petroleum company. 15% of the amount received from petroleum company, excluding the, we say that excluding the amount received, the amount received as what we call reimbursement. Maybe they used reimburse, amount received as reimbursement, amount received as reimbursement, amount basically received as reimbursement for work done, by PSS. And PSS, we know that petroleum service subcontractors. So amount that is reimbursed for services that they use their own money, that is excluded from the 15%, on behalf, done by the PSS, on behalf of the petroleum company, on behalf of the petroleum company, on behalf of the petroleum company, on behalf of the petroleum company. So we say that PSS payment of expenses on behalf, that is PSS, petroleum service subcontract, PSS payment of expenses, payment of the expenses on behalf, we say on behalf of the petroleum company, on behalf of what we call the petroleum company. So when that is done and they reimbursed, that is not part of the 15% of the amount received by the petroleum company. That is what we say. That is not part of the 15%. So then we need to understand that the tax rate the tax rate of 37, the tax rate, very important, the tax rate of 37.5% the tax rate of 37.5% is usually what you call a withholding, is usually a withholding tax by the petroleum company. So that tax rate of 37.5% is usually withholding tax by the petroleum company, which should be remitted, we should be remitted to the Kenya Revenue, to KRA, by, it's usually a withholding which should be remitted to the Kenya Revenue Authority by 20th of the following month. By 20th of the following month, we'll say by the 20th of the following month, after the month that you withhold it, after the month of withholding, after the month of what you call withholding, after the month of withholding. So that should be remitted after the month of withholding, after the month of withholding. That should be remitted to KRA in the 20th of the following month, after the month of withholding. That marks a discussion on the basics under taxation of extraction company, and to be precise, petroleum. We pick on examples, illustrations particularly pertaining to that. That is where we move to on the
So we can proceed to the elements, can proceed to discuss the elements. Let me discuss the elements here. Elements of accounting, elements of financial statements, elements of financial statements, elements of financial statements. Now, candidates, financial statements, before we look at the elements within the financial statements, it's important for us to understand that financial statements are formal records that provide a comprehensive overview of a company's financial activities and position. So financial statements are formal records that does what? That provide comprehensive or detailed overview of a company's financial activities and position. And these financial statements, candidates, comprise several essential elements that work together to paint a complete picture of a company's financial health. You understand? And the main financial statements include the balance sheet, or what is popularly known as the statement of financial position. So the statement of financial position or balance sheet has elements. Then we have another financial statement known as income statement. Within that income statement, there are also elements. Then we have the cash flow statement and the statement of changes in equity. So we want to analyze the elements of financial statements, beginning with the statement of financial position. So one financial statement is one statement of financial position, popularly known as the balance sheet. So this balance sheet has various elements, one of which is assets. One element, assets. Assets. That's the first element you will find in a balance sheet. If you have to look at any balance sheet, the first thing that will strike you is assets. And assets are resources that are owned and controlled by an entity that have future economic value, like cash, inventory, property, equipment, land, buildings, motor vehicles, and so on. Those are assets. They are owned and controlled by a company. If a company has assets, then those assets must be owned by the company. If it is motor vehicle, then the company must have ownership and control of the motor vehicle. Okay? If a company has an asset known as land, that is to say that there has to be evidence that the company owns that land. Evidence could be the title deed. And the company should also have control over such an asset. So the first element in a statement of financial position is assets. And I'm defining assets as resources owned or controlled by a company that have future economic value. The second element is liabilities. Liabilities. Now, liabilities are obligations or debts owed by an entity, external parties. So a liability is an obligation or debt owed by an entity to external parties. For example, a loan. If a company has a loan, that loan is a liability. Another one is accounts payable, also known as creditors. If a company has creditors in its books, if a company has creditors in the balance sheet, then that amount of creditors represents the debts that the company owes, say suppliers. Do you understand? We may have things like bonds. Bonds are long-term loans, okay? Short-term loans, long-term loans, accrued expenses like unpaid rent, unpaid salaries, unpaid taxes. Those are accruals. They are also part of liabilities. So that is the second element of the statement of financial position. The third element is known as capital. Capital or equity. The equity. What is equity? Now, equity is the residual interest in the assets of a company after deducting liabilities. So if you have assets and liabilities. When you deduct these liabilities from the assets, what you have is capital. You understand? That's equity. Capital or equity. It is the residual interest in the assets of a company after deducting liabilities. It represents the owner's on the company's assets, the owner's claim on the company's assets. And equity includes what we call common stock, retained earnings, share premium, reserves, and so on. You understand? So the balance sheet has three main elements: assets, and as we be continuing in our studies, we'll look at the categories of assets. We have the short-term assets and the long-term assets, or the current assets and the non-current assets. We'll also be studying, as we move along, the different categories of liabilities. We have the short-term liabilities, we have the long-term liabilities. Capital, we have different forms of capital. We have common stock. Common stock is also known as ordinary share capital. We have retained earnings. There is a share premium. We also have reserves. You understand? But these are the main elements of the balance sheet or statement of financial position. Now, the second statement, because currently we are discussing elements of financial statements. The second statement is statement of profit or loss. Statement of profit or loss, or simply the income statement. Income statement. The income statement. Statement of profit or loss, or the income statement. You understand? And it is the income statement that helps us understand or know the profitability of a company. And one element of income statement is revenue. Revenue. Revenue or sales. Okay? Revenue. Revenue is the income generated from the sale of goods or services, or from other activities such as investments. Revenue can be received from selling of goods and services. Revenue, what the company receives in form of after selling goods or services, that is revenue. Then we also have expenses as another element. Expenses. Expenses. These are costs that are incurred in the process of generating revenue. For example, rent, salary. We have stationery, advertising, cost of goods sold, and so on. Delivery costs, transport costs, internet costs, telephone costs, water, electricity, name them. Those are costs that are incurred in the process of generating income. If you are operating a business of, say, a supermarket, in the process of selling, before you sell, there are other expenses that are incurred. You need to transport the goods to the stores. You need to pay people who are selling at the counters. You need to pay the accountants. You need to pay expenses like electricity. You need to pay water. You need to pay food. You need to pay. For you to sell, there are other expenses that are incurred. So expenses that are incurred in the process of generating income is what we are referring to as expenses. These are costs incurred in the process of generating revenues. You understand? Utilities and so on. Net income. Net income. net income. Now, net income or net profit is the difference between revenues and expenses. And net income represents the company's profit or loss over a specific period of time. So the difference between revenues and expenses is what we are referring to as net income. So in an income statement, you'll have revenues, you'll have expenses. These expenses may also be categorized differently. We shall be looking at such categorization as we move along. Then the third statement is statement of cash flows. Statement of cash flows. Statement of cash flows is a statement that helps the users understand the flowing of cash. It represents the cash inflows and the cash outflows. The first element is the operating activities. Cash flows from operating activities. Cash flows from operating activities. You have cash flows from financing activities. And this could be cash inflows or cash outflows. The third element of a statement of cash flows is the investing activities. I should reverse this. We have investing and financing activities. Operating activities, investing activities, we have the financing activities. Okay, these are the major elements of statement of cash flows. Operating activities. What are these operating activities? Now, operating activities, cash flows from operating activities or operating activities, these are cash flows related to the core business operations, from the word operating, core business operations of the company, such as sales, purchases, such as payments to employees, and so on. Those are cash flows that are related to what? That are related to operating activities, related to the core business of the company. Then we have investing activities. Investing activities. What are these investing activities? These are cash flows related to the acquisition and disposal of long-term assets such as property, equipment, and so on. Investing. When a company purchases plant, motor vehicles, the non-current assets, the long-term assets, that's what we're referring to as investing activity. When a company sells or disposes motor vehicles, land, equipment, and other non-current assets, that is also investing activities. So investing activities refers to activities related to the acquisition and disposal of long-term assets. Then lastly, the other element is financing activities. Financing activities. These are cash flows that are related to the changes in company's capital structure. Changes related to company's capital structure. Do you understand? Such as issuing of common stock or ordinary share capital. When a company issues ordinary share capital, or when a company repurchases ordinary share capital, then that is a financing activity. When a company borrows money, okay, borrowing of loans, that is a financing activity. You understand? When a company repays loans, that is a financing activity. So the cash flow statement, the statement of cash flows provides insights into how a company does what? How a company generates and uses cash, which is important for assessing the liquidity and the financial stability of a company. So this is statement of cash flows. The other statement we need to consider is the statement of changes in equity. The third statement or fourth statement is the statement of changes in equity. 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 Changes in equity. Candidates, we are studying the elements of financial statements. The first statement is statement of financial position, also known as the balance sheet. The second statement is the income statement. We have the statement of cash flows, and now we want to identify the elements of statement of changes in equity. Statement of changes in equity. And we recall, candidates, we defined here equity as comprising the ordinary share capital, the share premium, the retained earnings, reserves, and so on. So the first element, if you are to have a look at any statement of changes in equity, the first thing you will see is the beginning equity. Beginning equity. Beginning equity, or the balance brought down from the previous period. The balance brought down. The balance at the beginning of the accounting period is what we are referring to as the beginning equity. Beginning equity. This is the equity balance at the start of the reporting period. Then you'll have 2, the net income, or the profit for the year, the net income. This is the profit or loss for the period, the profit or loss for the reporting period or for the accounting period, which increases or decreases equity. If it is a positive, if it is a profit, it will increase the equity. So you have the beginning equity, you add on the net income. If it is positive, it will increase this equity. If it's negative, it will reduce the equity. So we have the profit or loss for the year, for the reporting period. Net profit for the reporting period. You understand? We may also have other comprehensive income. Other comprehensive income. Other comprehensive income. These are changes in equity not included in the net income, all right, such as unrealized gains or even losses on investments. You may have dividends, as part of statement of changes in equity, dividends. Dividends. These are distribution of profits to the shareholders, which decreases equity. Five, stock purchases. Let me say, first of all, stock issuance. Stock issuance, stock repurchase. Stock issuance or repurchase. Stock issuance or repurchase. These are activities that increase or decrease equity through changes in the number of shares outstanding. You understand? If the company issues shares and shareholders buy the stocks, that will be part of the statement of changes in equity. If the company repurchases the stocks that were previously issued, then that again is part of the statement of changes in equity. So candidates, we are just highlighting, but as we move on with the subject, we'll be delving deeper into these elements. This is just introduction. We are introducing the elements of financial statement. We are just mentioning, but as we move along, we'll be looking at illustrations on how to prepare the statement of financial position, income statement, statement of cash flows, and also statement of changes in equity. But it's important for us to acknowledge that these financial statements are interconnected and they provide a holistic view of a company's financial performance and position. Because we know that the net income from the income statement flows into the statement of changes. This net income, it flows, you can see after preparing the income statement, this will flow. This is part of that. So they are interconnected. Just giving an example. Okay? It flows into the statement of changes in equity. It also reflected in the balance sheet. This one, we shall see later on, is also part of the balance sheet. So they are interconnected. Some of these elements are interconnected. And the statement of cash flows explains the changes in the cash balance in the balance sheet. This one. This statement explains the changes in cash in the balance sheet under the assets, because the cash is part of assets. So this statement explains the changes in cash and cash equivalents in the balance sheet. So you see there is that interconnectivity, right? There is that interconnectivity. So by analyzing the financial statements together, stakeholders can gain a deeper understanding of a company's financial health. They can make informed decisions and they can assess the company's future prospects. Is that clear?
Right, so I have some data here and some tasks I've set up. I'll share this with you afterwards, so you can also have a go. Right, so let me move this out of the way. All right, so I have some data here and some tasks. The first task I've created is inserting a row at the top and adding a title. The title should be staff basic information. So how do we insert a new row? Right click, insert. Okay, we've done this before, so it shouldn't be a problem. Insert, then we'll do type the title, staff basic information. And we can start with some of the shortcuts. I want to, let's do this. The first one has to merge this, the title in the range A1 to J1. So I will highlight all of this. and go to home, merge and center, right? Merge and center, and probably I did not include it among the tasks, but if I do Control B, that's one shortcut. It bolds the text. So I can also increase font size like we have learned before. It just looks more like a title, right? So for this section, the title of the columns, I can do Control B as well. If I want to italicize them, I can do Control I. That makes them italics. And notice some of them overlap sometimes. So if you have something like this, for me to display it, I'll go between where the two columns meet and double click where the two column letters end. Like if I wanted to adjust the space between E and D, I would just double click between E and D. Right, I hope that is clear. Okay, so we are doing a number of things all together. Remember, like I've said, for this lesson, we want to go over a number of shortcuts. I'll do a summary in the end. So we have already done Control B, Control I for this. Then suppose I wanted to do a bit of formatting. Again, some things we have done in the past. Control, then I can put, or rather Home tab, then I can put some borders so that my data looks a bit more interesting. I can also apply some color and so forth. We've done this before, so I'm just doing a bit of a recap. Formatting, we said presentation of your data is quite important. So then let's do the last bit of formatting here so it looks more interesting, more catching to the eye, appealing to the eye. Yeah, that looks more interesting. All right, so we are on task number 2 here. We have marked and centered this over that range. So this is some of the content I intended to introduce today, creating some validation rules. Validation rules put some restrictions on the kind of data that you can enter in a specific range. So it could be restrict them by number, restrict them by the kind of text that should go there, and so forth. So like here we have said, the rule should be the age. The rule for age should be only people between 18 and 70 should be allowed. So people who are adults, basically, who are within the acceptable working age. After 70, they'll probably be retired. So what we want to do is create a rule. Step 1, you will highlight the section where you want the rule. That's step 1. Step 2, we'll go to this data. Okay. One way to get, another way to get there is, there are shortcuts for that, but for now, let's use this long method, data. Okay, then I go to data validation. Data and data validation. Then I'll click on this. Right. Data validation, then I want it to accept only numbers between 18 and 70. So I'll come here and look at this list. I probably want whole numbers. So the choice you make here depends on the kind of numbers we want. For ages, let's say we'll only include all numbers for age. Then we want between, so we keep this between. If we wanted only above 18 without an upper limit, we then say something like greater than or equal to 18. But right now we want between, it has a lower limit and a top limit. So we will do between 18, that's our minimum, and 70. We can use this to restrict the data that will be input there. If I click OK, then if I try to enter anything here that is outside that, so it will give you an error message. It is invalid data. Okay, and I can also choose my own, create my own error message. If I went here and edited the rule, I go to validation and I want an error alert. my own choice. So notice this is settings. I can create my error alert here. I say invalid entry. Tell them enter. So a more meaningful error message. So if I do something like now, I enter something like 75. You see invalid entry. Enter the correct age. Okay, so then the person will be reminded what they want to do. You can even make it more explicit by, say, for example, telling them what they must enter. So enter an age between 18 and 70, so they know what the problem is. Okay. So if this happens, the error message is even more meaningful. We can put some random ages here that meet the criteria. So we do a bit of data entry. Still working. Data that is acceptable. So I've entered some values there. So let's try the next one here. We want to create this task here. It says create a lookup. A lookup. So the question is, what is a lookup list? So we want to restrict the kind of thing that can be entered here. It's still a validation rule, but this time we want it to, the person is given only two choices. They're supposed to, the status is either supposed to be married or single. Okay. Make sure you alert me if there's an issue. If you cannot see my screen, let me know early enough so I don't go too far without us communicating. All right. So I'll say this section, we want to create a validation rule. All right. So highlight that section, same procedure used for the other one. Then we go to data, and data validation. In this time round, on settings, we choose list. Okay. Then, because we are not getting our list from somewhere else, we will not click on that. Instead, we will type the options. So I'm just typing options and I'm separating them with a comma. Okay. That's simple. Married, comma, single. So there will be other contexts in which you will want the user to choose something from a list. You're not giving them many options. So for example, let's say you are creating a simple system for charges. Let's say there are charges for entry to a national park or something like that. There will be categories of people. There will be people who are citizens, people who are residents, people who are non-residents. Only like 3 categories. So you don't want somebody to enter other options. So if you look at this, one is restricted to only entering what is on the list. If I try typing something else, let's see. Sometimes it will refuse to accept that because we have created our rule to only accept either married or single. For divorced. Okay, so if we do this, we can now enter data from there. This randomly. Okay, so I'll ask you to retry this on your own, but I'll be sharing this worksheet in a bit. I'll give you time to retry it. So let's see if we are making progress. So that is data validation, restricting text entry. Okay, so we have just a quick rerun. I have highlighted the section. On to data validation. Then this time round I chose a list. Okay, you would choose decimal if you want decimal values that have decimals. So let's say, for example, you had a worksheet where you had currency or something like that. You want to provide for some decimal values. Okay, if it is a currency, like for example, these places where we have basic pay. If we want a restriction, let's say people must earn above the minimum wage. So we can have a bottom, a lower limit. But when we're choosing that, we probably want to use decimal because it will have decimals at the end. So that is a quick rerun of this. Okay, I think we have not looked at the other options. Let's see what else is there. There is list, whole number, date, time, text length. We'll restrict it by the text length. So if we only want, let's say, for example, there is a field that should be an ID, staff ID, like this one on this side. You probably want to reduce the chances of an error by restricting the length of the number of characters that people can enter. So for example, for my ID field here, I can restrict the number of characters, say, to 5, so that there is less chances of people making an error. So I can do this and go to data validation, then I say text length, then I can have a minimum of equal to. If I say equal to, it should be, in this case, let's say it is 4. Then somebody must enter some 4 characters. Let's try to enter something shorter. That one is, let's try it here. See, if you enter something that does not meet the condition, then you get an error message. So validation rules are very useful for helping you capture errors. Like when during data entry, if there are already rules in place, they will prevent the user from making certain errors. Okay, so those are a number of rules. Let's see the department. These people work in certain departments. Let's say we have a number of departments, which we can also use a rule to create. So I will do a number of departments using the same procedure. So I go to data entry. This time it's a list, like I said. Then I say I have HR. Let's say there is sales, it's marketing. Well, let's say sales and marketing as well. Say nations and so forth. So if we do that, then I get a list of options. So some of these are in sales. Let's say this one is in. So we can then pick this randomly. For our purposes here, I'll just pick it randomly. Say marketing. Say IT, communication. So the point is, it helps you data entry. So I don't have to go typing the whole thing. I just type the first character, it picks up. Okay, so I can do more. Then sales, right? So it helps with data entry. Right? Remember to ask any questions if you have some. Just make sure you don't go too far when you are not following. Then basic pay, I will, let's see, are we still following the tasks? Let's make sure we're doing that. So we have create a rule for basic pay so that it does not allow figures below 15,000. Okay, so we want to create a rule so that it does not allow figures below 15,000. So I will do the same thing, like data. And if we look at the options here, we'll still do a whole number, and this should be greater than or equal to 15,000. say OK, then it will have a restriction here. So I can now put some basic pays. Let's say I have this one as 55,000, 60,000, 20. This is random for the moment. And so forth. So I'm putting these figures here so we can use them in the next item we're going to cover. And so we also said with currency, so that you're able to differentiate the thousands and so forth and millions, we might need to do some formatting so that they have commas and decimals. So I'll show you that in a minute. So we will highlight the whole section and go to the home tab and select that comma. Okay, so we have, you can differentiate, like this number here is a little too much bigger than what I had intended. Literally 75,000. You can also include currency symbols if you need to. You see there is this one here. So we'll have dollars, pounds, currency, and you can pick the symbol you want. There's a big list here, including all sorts of different currencies around the world. And the decimal places you can also decide